Hello. Very
Hello.
excited to host today's webinar on IT services valuations in 2026. The last one was around half a year ago, so we thought it was time to do another recap of what we've seen. And there's been a lot going on, so it's actually super important to refresh and update our knowledge and share our findings. As usual, I'm Marcin Majewski, founder of Aventis Advisors. We're a boutique firm, and I'm accompanied here by Filip, who's a
Hi, everyone.
director at our firm. And yeah, our goal is to share our knowledge, our findings, what we learned over the past few months, so that you can make better decisions in your businesses and in your investments. House rules, maybe, first of all. If you have any questions, then just type them into the chat box and we'll be happy to answer them either during the webinar or after. Without further ado, I think we can jump into it now.
Yes, yeah. Let me just
Good.
share.
Also, the slides will be available as always following this webinar. We'll post them online, so you'll be able to get all the insights into your inbox. Very well. So, Philip, will you walk us through the agenda for today?
Yep, yep. I mean, I think we had our last webinar, as you said, around half a year ago. A lot of things have changed since then, so it would be great to see again where we are, and first in terms of the public market, because a lot has happened with the stock prices of software companies. Everyone's been discussing that. Apocalypse, but then Nvidia is at an all-time high, so we decided to kind of throw in here IT services and see where we are in that industry, and then see how it translates to private markets, what's going on there, how valuations are in private transactions, and then some trends in IT services, what we are seeing from companies that are being bought and sold, from investors that we talk to, kind of what is hot, what people want to buy, and on the other hand, what people want to sell, and kind of where there is more demand than supply. And in the end, as everything is about AI these days, we're kind of thinking how to position yourself as more of an AI services company and how to get the premium valuation, because that's what most of the people are looking for right now. And we wanted to start this with the news of the day. Just yesterday, OpenAI finally launched their AI implementation company. They've been talking about that for quite some time, that they want to establish a separate company together with some of the leading private equity funds, some of the leading consultants such as McKinsey and Bay, to actually implement AI in the companies. It's not that easy, and they felt like it would be a good move to have their own systems integrator or their own consulting company. So just yesterday, they announced their acquisition, Tomorrow AI, and AI consultancy firm out of London, 150 people. They're doing some quite interesting AI stuff for enterprise Fortune 500 companies, and that's the first acquisitions of OpenAI. We're seeing that it will be going that way, that there will be more and more interest towards companies that are actually doing the implementation of AI, maybe a bit less towards traditional services. I think it's great opportunity for anyone who is involved in AI services or has a significant revenue stream from that you can be acquired by that company. And we'll see how that's going to develop, if that's going to be a roll up and they're going to be buying companies across the globe, or going to be doing some greenfield investments. But I think it's a major development, kind of OpenAI getting into the business of IT services themselves. And Marcin, I think it's not the only one, right?
Correct. Yes. So this is old news already because it's already 1 week old. Anthropic did exactly the same. but with the backing of the biggest names in private equity. So Blackstone, Hellman and Friedman and Goldman Sachs, and a bunch of other private equity firms. So they led the way, and apparently OpenAI was a very quick follow. It only took them a week to launch a similar operation. This is remarkable how fast this is moving, and we're actually very curious how this will affect the industry, because are they coming to eat the lunch of IT services companies? So that's why here we wanted to have a poll to get the pulse. If you feel like AI is gonna eat the industry or not. So we have a very quick question. How do you feel about the long-term impact of AI and what the hyperscalers do on IT services business? Do you think it helps and accelerates growth, or they will just capture the market and disregard completely the ecosystems that they're challenging? So I'll make my choice. Oh no, but I cannot vote. But we can give maybe a minute or so.
Yeah, I see already 60+% of people voted. Almost 70. Were a great turnout today in voting. So I think we're gonna be completing this soon. Yeah, so net positive, there are some arguments for that. Net negative, not sure. Yeah, I see it's slowing down, so I'm just gonna close this.
Positive, that's very good.
Yeah,
that
so
was
55%. 55% net positive, net negative 24%, not sure 21%. Then it's a buying opportunity. We'll see on the next slide. I don't think
exactly, that's the point I wanted to make. Yeah.
That's not what market shows, unfortunately.
Exactly.
Yeah, so as always, we have our IT services index, 187 companies from across the globe, equal weighted, and we monitor how that performs against NASDAQ. I think last time we checked in on IT services in our webinar, we were somewhere mid-late 2025, so all-time highs, 800 points, and a very slow decline of IT services after 2022, but then slower growth and reaching all-time highs. Yeah, together with NASDAQ. And what we're seeing is where the real difference is the most recent couple of months, where NASDAQ is going up, mostly led by NVIDIA and all the chip companies, but at the same time, IT services companies are going down across the board. So this is a global index, so they're going down across the globe, and I think more so in the US. So when we checked on some of the biggest US listed companies like EPAM Systems, Globant, Endava, and the like, so their share prices dropped quite dramatically over the past couple of months.
So are we bullish or bearish, Filip? Or we have diverging opinions?
There are some arguments for both cases. I don't know, which ones do you want to say?
I'm bullish, especially after our poll, which reinforces my intuition that there is much more work to be done, and it's a big boost for productivity. So it gives big leverage to IT services companies, and someone has to implement all these projects that AI facilitates. So I think in the long run, it will lead to margin expansion and growth in revenue. And definitely, relatively to SaaS, IT services companies are much better positioned. they can adapt much more easily to the changes in the ecosystem.
But do you think bullish for the incumbents as well, for IBM and the like?
I think they will adapt. They will learn to live with AI. Yeah, I'm quite sure. I mean, not everyone. There might be some reshuffling. And we see these small, nimble AI native IT services companies emerge. They operate very differently. But as they scale, I think founders exit them. They sell to Accenture, they sell to Kyndryl, they sell to large systems integrators, and I think they will acquire these capacities. So it's just a matter of time. I mean, they're just big financial engines that have gone through so many shifts in technology that I think they will be they will be able to handle this one as well. But in the short term, I mean, there's clearly negative sentiments to these companies. We see this in the stock market, we see it in private deals, maybe less so in private deals, but still it's happening. So short-term bearish, I think we have some downside risk, maybe 20% more. Long-term, definitely bullish. You?
Yeah, I think now those companies are much more attractively priced. I think part of this movement is just going back to some more realistic valuations. So when I see those names at 6, 7, 8 times EBITDA traded, that's completely different from COVID period when some companies.
Yeah. Filip, did you freeze? We have technical difficulties today, I think. So I will continue with your back, Filip, or it's on my side.
I don't know.
I lost it for a moment.
Yeah. No, I was saying that the pricing model breaks down a bit for a lot of those IT services companies, and they're kind of struggling to reinvent themselves, and they need to reinvent themselves to the model where you pay for performance and for results and not for the time build. And that may put some pressure on revenue growth. The AI and kind of using tokens may put pressure on margin. Yeah, so that's kind of becoming more expensive as developers use it.
Yeah, the model will change. For
yeah,
sure.
the model have to change. So that's why I would be a bit more skeptical for the incumbents and how quickly they can turn around companies which have tens of thousands of staff usually across the globe and some processes which are very well established. Yeah, so they may need to be much more nimble, agile, yeah, to turn themselves around. Yeah, and moving on kind of to the what happened this year. Here we plotted NASDAQ 100 index, our Aventis AI index, which is mostly semiconductors, data centers, energy providers, kind of all AI supply chain, versus IT services index. In February 26th is around when Claude Code came along. So I think this is the major reason for underperformance of IT services index. So the market kind of following Claude Code takes a bearish view on those companies, and we're seeing minus 19% performance of this index versus plus 10% for NASDAQ 100 in general. And I see a lot of this is just spending shifting further towards hardware, towards tokens, data centers, and so on. So we heard stories that Anthropic went from $3 to $30 billion ARR just overnight or over a couple of weeks. I think a lot of the spending is shifting from where it could have gone, which IT services. Yeah, so kind of IT service companies are getting less of that, and LLM or model developers getting more of that. even if it comes through an IT services company. So they buy tokens to deliver the service to the client. Okay. The multiples, Marcin. How are the
Multiples. So yes, so here we have in this EBITDA multiple chart, we see the repricing that happened in the beginning of this year, actually. Why is that, Filip? Actually, why such a sudden drop from around 10 to 8? Because
it's the same. It adds up to me to minus 20% here. So 10 to 8.
But that's because of our cycle of updating the data, I'm guessing. Which is actually interesting because the backdrop is growing my EBITDA volume. But anyway, I mean, the market is not buying it, is not believing in the growth story. We are on the opposite end. We believe it's going to grow. So anyway, it's still moving in the same band, essentially, between 8 and 12. So it looks like fairly cheap. It's a great time to buy, probably. Maybe not such a good time to sell, but at the same time, I mean, you never know how long it will stay in this band. I mean, in this fairly low level. Will it bounce back to the next quarter, or will it take 2 years to recover? But anyway, from a cyclical point of view, probably not the best time to exit IT services companies, and unless they're in the AI space and you can sell to OpenAI. But it's a great time for sure for acquirers to buy some discounted assets. We can look at the other chart also. Okay, yeah, this is the point I want to make. So no apparent reason. I mean, okay, minus 10 percentage points in EBITDA margin since COVID peaks, but actually we had a very good year in 2025 when profitability recovered. So yeah, not exactly, we don't see exactly reason for the repricing in the fundamentals.
I mean, I think they're repricing the long-term value of those companies, because I agree. The margins are the same. The next one is the growth rate. Yeah, the growth rate is the same, around 5-6%. The profitability is the same, EBITDA margin 10%. Again, super stable over the past couple of years. So I think what the market is saying is that, yeah, for now it's 6% growth, 10% margin, but in the future, one of those is going to be lower. Yeah, we don't know exactly which one, but it's going to affect earnings through the revenue growth or through low margins.
Or the risk perception is increased, that you cannot bet on the incumbents anymore. That the investors are not that confident about their survival. That could be also the case. Yeah.
So this one we were looking at IT services valuations by region for quite a long time. I think when I first did this webinar, the green line India was above 20 at the very peak, and we were discussing what's the reason for that, and we're not finding any really. So now it's all coming back to earth. Indian companies are now at 13.2 times EBITDA multiple, and I think it's gonna converge more or less to where all the other regions are. What we're seeing is Europe 9.2, North America 8.1. So roughly at the same 8 to 9 times EBITDA level. So I think Indian companies are gonna go down there. And especially given the fact that there are a lot of arguments that those services which are outsourced to India are first to go, and they're gonna be automated by AI, and those are kind of the most basic type of IT services.
Yeah.
Yeah, we'll see. We'll see how that's going to develop. But I've seen the chart, for example, the call center workers in Philippines. The number of call center workers keeps growing just because more and more companies can afford this type of service thanks to AI. So maybe we're going to see this similarly in IT services and outsourcing to India, that those companies' fundamentals will still stay strong. Yeah, but with this decline, it's difficult to read what's actually the reason here. Because if they were valued, those companies, 2 times the rest of the world, and now suddenly going down, well, it may be just kind of convergence to global valuations and has nothing to do with AI.
It looks to me like convergence, maybe some idiosyncratic risk for India that
Yeah.
emerged. But I agree. I mean, people are trying, we think that they can replace humans with agents. I think they will just team up. We'll have human agent teams that will be way more powerful and will be able to achieve more. And you will find more jobs for humans to work with the agents just because they're just so much more productive. And I mean, I think we're quite advanced in deploying AI in our company. And I mean, as much as we try, I mean, it's useless without someone without the human in the loop. And I mean, with LLMs, I don't think it's ever happening that they will be able to run on their own. I think it's just structurally the technology is too limited, too crude.
Yeah,
For
you need the people to
advanced
connect it, integrate, connect APIs, kind of talk to each other, and so on and so forth. So
yeah, but also make sense and evaluate what they produce
yeah.
and calibrate. I mean, you can have a very small use case running standalone, but it still needs, yes, a lot of setup.
Yeah. Let's move on to private markets. So private markets historically have been quite stable. Here we look at a sample IT services transactions, both at the EV revenue multiple and EV EBITDA multiple. EV revenue multiple has a significantly larger sample. EV EBITDA multiple, a bit smaller sample. So we have a data here with a lag from 25. But we're seeing similar type of developments here. That there is a decline in multiples happening, but overall over the past 10 years, the multiple oscillate at around 9 to 11 times EBITDA, and those are for deal size. The median deal size here is $40 million. So those are companies with probably around $4 million of EBITDA. And of course, as the company size grows, the multiple usually also grows. And the other around, if you go to the lower end of the revenue size or EBITDA size, then those multiples are a bit smaller. Yeah, so here are the totals for all multiples across the years. Median 10.3, EV revenue 1.3. So the margin of companies is around 10%. So adds up to what we have, and EV EBIT 15.6. But that's not used too much in IT services. I'd say that EV EBITDA 10 times is what we're seeing.
Can we go back to the previous slides? I would be curious to look at the trends and maybe we can see from this chart where the market is heading, because the range of outcomes of multiples is increasing apparently since 2023, but we're in a downward trend from 2021. So if someone is considering a sale in the next 1, 2, 3 years. What would be your advice, Philip? Should they wait?
Uh,
How should they time it?
I mean, looking at this, I'd say that this data comes with a bit of a delay. That we have, peak in 2021 is good, 22, 23 is also good. But now, with the market going down, I think this will feed to the private market valuation. Yeah, so the deals will be repriced. Yeah, so if someone's starting at going out right now or started February, I would expect that some of those transactions will be repriced based on what we've
Yeah,
seen.
we've seen that already. Yeah. So 2026 is gonna be a drop, probably, no,
Yeah,
in multiples because it follows the trend in the stock market with a lag. So when is a good time? 2027, no? 2028 probably,
yeah.
unless there's a big crisis.
I
But
mean,
we had a
once the
discussion
market picks up,
today.
yeah.
Sorry?
Once the market picks up back and kind of the decline stops, because now the gap between overall market and services is quite large. What
Yeah,
happened to date?
yeah, yeah. The new Fed chairman, we don't know how he will behave also. That actually will drive a lot of the price action in the market. So I think it's also important to wait for that. I mean, to me, today is the time to consolidate, to reinvent the business. And unless, I mean, there's a reason to sell, probably better to give it a while and see where the market heads. And later we'll talk about what you can do to make your business AI ready. There have been some questions in the meantime I wanted to answer. The webinar is being recorded, so we're gonna share the recording. So the charts also, the whole deck will be available online. EV here, sorry, EBITDA here also in this chart. This is as reported, so we don't adjust in any way. So it's the reported EBITDA.
But usually, because the deal sizes are here larger, yeah,
Yeah,
so for Milan EBITDA, it's not gonna be a very big effect here.
yeah. Okay, I think we can continue.
Yep, let me continue. Yeah, looking at the regional split of valuations, we've also been tracking for quite some time. I don't think there's a lot of movement here. North America, slightly better valuations than in Europe. Asia, very good valuations, I think mostly due to fast growth of the companies and mostly due to India. We've seen kind of what's been going on in public markets in India, and this usually feeds to private valuations as well. So those are pretty much in line with what we showed here, that the red line of North America has been above Europe for most of the time, and then India, which is part of Asia, has been also above the rest of the line for
Yeah,
quite a long time.
but very interesting this has flipped here. So US, we didn't actually notice this, that US trades now lower than Europe. That's a very interesting development. So and that's contrary to what we see in the private data. I mean, that's a long-term average, but that's a big one.
Yeah, so we move on.
Yeah. Okay, so here we take a look at where the market is heading, where is the value, and what companies are facing a existential crisis and should really think about reinventing themselves, or they have to sell at a discount. So the premiums we see in areas that are most affected by AI. One segment is cybersecurity, and I manage the cybersecurity services providers. These companies benefit from the fact that it's easier, cheaper to deploy AI-led cyber attacks and exploit bugs in software. So we see them grow very fast. We see very good interest from buyers. Second is AI implementation companies that understand how to sell AI projects, have some credibility. And there's much demand for these companies because legacy players, they need to either build these competencies in-house, which isn't that easy because it's a different philosophy of delivering services, or they just have to buy these competencies. So they just decide to buy a lot of times to cut the time essentially to market. And lastly, we see good demand still holding strong for vertical specialists. So companies that know one particular industry, no longer generalists with scale are that interesting, but exactly the companies that can tell the AI essentially what it should do because they know a particular industry like healthcare or manufacturing, pharmaceuticals, insurance. These companies are much likely to stay relevant because they just add more than just the coding skills, which in clients' eyes can be replaced by AI, essentially. So they have better pricing power, essentially. Filip, any comment on this one? What were you seeing?
I'd say data, I would say everything related to data is also commanding premiums. So partners of Databricks, Snowflake, all those ecosystems, I think there's an argument to be made that to have good results from AI, you need a very, very clean data, and not many companies have this. It's scattered in different Excel databases and so on. So companies who help with that are going to also be in the supply chain of AI. Otherwise, I agree, vertical specialist is kind of similar themes to what we talked in software, that, someone knows vertical software very well, so not so easy to replace with AI. I think same here. If you can consult very well for a particular industry, then you become a partner in the implementation, rather than person to replace.
Yeah. And these companies, they tend to be easier to sell, shorter time to sell, and the valuations 7 to 14 times EBITDA if they're, say, in the average growth rate of 10 to 20%. That's probably what we can expect. Now, compression, we see a lot of industries being affected. I mean, it's not that new, and I think a lot of it is due to a shift in sentiment, not that anything changed in fundamentals. There are just fewer buyers interested in these companies because the arbitrage between public and private markets and the arbitrage between larger and small deals isn't there anymore. So anything that touches legacy systems, not much demand. Undifferentiated outsourcing, body leasing, staffing, not doing great. There's this perception that you can replace staff with labor with AI, and to some extent you can. But so these companies, we don't see a decline in profitability in revenues. They do okay. It's just there is the sentiment isn't there for them anymore. So these companies will take longer to sell, and the valuations are not that attractive. So 5 to 8 times EBITDA for a regular business with similar KPIs to the green ones, but just there's not demand, not that much demand for them. Filip, your thoughts?
Yeah, I agree. I think here AI gives most pressure to time and material model, especially for staffing firms which don't do project based too much. Yeah, so it's kind of, they're under pressure because companies want to pay less. Yeah, and then developers need
Yeah,
to work less. Yeah, and that's not very good for time and material based company if the developers are doing faster. So it's a bit of a conflict there.
that is true. Yeah,
Yeah, otherwise legacy systems, yeah, I would agree. There are new companies popping up, new ecosystems. So those ones are, I mean, similar point to you. The performance is good. It's just not a lot of buyers for this. Yeah, and that's why
yeah,
the valuations are compressed. So if someone wants to exit or needs to exit, we just have to take a discount, yeah, on the company value.
yeah, yeah. It's all psychology now. Just a shift in psychology that we're seeing so far. I mean, it hasn't upended the industry so far. We haven't seen that yet.
Yeah.
So, in the last slide, we wanted to talk about some of the ideas and observations we've made as to what differentiates companies that can leverage AI to work for them and build part of their valuation. So, we have a few ideas here. One is just to start doing it and building some track record because ultimately, if we understand investor psychology, they are looking for future earnings potential. And they're afraid about future earnings if AI takes over the market. So you need to show that AI is your friend and you're riding the tailwinds. So the best way is to start doing it and to have a lot of case studies to showcase that you know how to leverage it to your advantage. So that's number one. Another thing that is we're seeing companies do is marketing and refreshing positioning. And we see all kinds of companies just rebrand themselves. A lot of that is fake it until you make it because there's very little substance. But I mean, people just expect it. So if you don't market yourself as an AI company, I think you just look stale. And I think that that can be a disadvantage in winning new projects and also in selling a business. So
And the AI doesn't recommend you because the AI reads what's on your website and recommends
yeah,
companies that have AI on the website for AI services.
exactly. Yeah. So it's kind of a loop because
Yeah.
now your clients are using AI to buy services. We see that a lot. I mean, how it's easy to trick AI into recommending a product or a service. It's a new industry called Geo, Generative Engine Optimization, SEO, Search Engine Optimization. So it's a new a new line of business for all kinds of marketing agencies. Good to pay attention to it. So what's next in store? Yes, delivery. I think this is the toughest. I mean, it's easy for us to talk about it, but redesigning your delivery. I mean, we're not that technical to tell founders how to run their business. But what we can say is that we've seen companies reorganize their teams, their workflows, and we've seen real results. So definitely there's potential here. Mm, but how to go about it? I mean, it really depends on each company. Some things are easier to automate, some things are harder. We try to use AI for everything in our business. And I mean, the speed at which we deliver stuff now It's very hard to compare. So quite sure in IT services is similar. There is a lot of resistance for sure, because I mean, developers for a long time, or IT professionals in general, they were like, it was an employer's market. So they were accustomed to being pampered. But now, and when you ask them to change the way they do things, it's tough. We see and hear a lot of stories how difficult it is to change habits, but I mean the survival of businesses depends on it. We're quite sure. So it's definitely worthwhile to put your energy to overcome this resistance. And last point, yes, I mean AI is a great tool for understanding performance, and we've deployed AI to run all kinds of dashboards in our business and understanding what's going on. And I mean, with Claude as a partner for strategic decisions, for understanding the world around you, Claude or any that you like, we see also a lot of potential. So all kinds of business plans, strategizing, this stuff is extremely potent, extremely powerful if you want to make shifts in the business. So I think that perhaps our webinar, we have a few minutes for Q&A. If you want to talk to us, please do call us, email us, use the contact form or LinkedIn to reach out. We'll take a few questions. You can type them in the Q&A if you have questions. You can switch off the screen, Filip, I guess.
Yep.
And let's maybe tackle the questions. Okay, Arun asks, is there a consolidation expected in the IT market? And do you see, and another question, do you see the pricing model of IT services changing to be more outcome-based? Very good questions. And consolidation is happening all the time. Although it's also an opportunity for newcomers to emerge now, and they have leverage with AI. So it's a mixed bag. I'm sure the consolidation trend will emerge, but also I think like nimble small companies will also become quite powerful if they use AI. So these trends oppose each other. So I don't expect a lot of consolidation in the next few quarters at least. Once the technology matures, probably. But pricing model for sure, I mean, it's changing. We see a lot of companies implement shifts, and they embrace again fixed price, because if you're good at using it, you can deliver much more cheaply. And clients are accustomed to paying a lot of money for projects. If you can hack that, you can keep the margin. So definitely easier to sell outcome-based. Okay, what else? Maybe you take this one, Filip. Top 5 investment risks which are not available in SIM or provided by sell side. That's a tough one.
That's a difficult question. Yeah, usually I would prefer everything that's available in the. I'd say that the team.
The key person risk,
Hello.
essentially. Yeah, you're back, Filip.
Yeah. No, I was saying about the team and the key personnel in the company. So that's where you can have great resumes and great managers on paper or in the sim. But I think that during the deal process and during the negotiations, you will see kind of more closely what are the strengths, what are the weaknesses of the team, and if you want to buy them.
Yeah.
So I would invest into some in-person meetings maybe, or something like that, if you're serious about buying the company. And then yeah, that would be.
I agree, because the
something which is
company
not
might
in
do
the numbers.
well. The company might do well today, but there's no certainty it will do well tomorrow. because their market might not be there anymore if Anthropic goes after it. But then if the team is smart, they will reinvent the business. They will find a way, and they will leverage the technology to their advantage. Yeah. Okay, what else? In which of the two buckets you do see IT services firms linked to strong ecosystem? Microsoft, Workday, SAP, Salesforce, Oracle? Yeah, that's another good question. I mean, you cannot put them all in the same bucket because even in Microsoft ecosystem, you have so many products and there are different life cycles so Azure has different dynamics than for instance Microsoft Dynamics.
Yeah.
So it all depends, and you have to evaluate ecosystem by ecosystem to understand. But I mean, we're strong believers in Microsoft. Actually, they treat their partners well. Other ecosystems, it all depends. I mean, but Microsoft definitely. I mean, there's been ever since we've been at it, there's been demand.
I'd say based on our chart, it's gonna be roughly in between. It's not the hottest thing on the market right now. Yeah, there's been a lot of consolidation across all the ecosystems, but it's also the companies are nice. They have enterprise customers. They have been in the market for a long time most of the time, so it's kind of roughly in between. Not the worst. Also, yeah.
Yeah, yeah. Good. What else can we comment? India. We are seeing premium companies with US revenue India delivery. That is correct. Yes, we see discount for companies who are subcontractors and only work for Indian clients. That is true.
And some of those companies are highly profitable. If you manage to land clients in the US and deliver in India, then it can be a great business.
Yeah. Especially if you have people stateside that also can do some selling and pre-sale.
Yeah. The risk we see with those companies is sometimes they have great profitability because they have no sales and marketing. So they have one client or a couple of clients which are dominating. And then this is a big risk. And it's very difficult to sell or difficult to put a high value on the company, even if the fundamentals are very good.
Yeah. We have a question from Michael. Hi, Michael. Long time no speak. Can you support the thesis that clean data is important for AI integration, other than its common sense? And that's our experience.
I don't know. That's from our experience. Only from our experience, and we are not like a big data company. And I can imagine a company which deals with millions of records. It's super important.
But I was a panelist at the discussion, and that's exactly what other people that are more versed in AI said, like bank IT managers, that the data is the number one concern, because without data, I mean, the AI is as good as the data that it gets to work on. Another question from Zhigintas. How would you position an IT services firm that has substantial part of revenue coming from sale of equipment? This is a tough one. We get that a lot. We see that a lot. These companies, from our experience, they rarely sell successfully. Somehow they get very steeply discounted. We had this discussion earlier today that perhaps there is some chance that you can sell it as an AI company if you deliver components for AI. And as hardware gets more scarce, it's getting more valuable. So if you can trade hardware well, I think there is some margin, extra margin that you can make. And maybe now is the time to leverage that. But in general, I mean, right now, very tough. Unless, I mean, you can justify that you're dealing with GPUs, then maybe if you're a great GPU dealer. But and then there's that much potential. So I hope that answers the question.
Yeah, for data companies, I think the data platforms are growing rapidly. Databricks, Snowflake, and all the other ones in the Gartner ecosystem. I think that would be the biggest point towards the fact that data is interesting, and the companies around them, all their ecosystem is also growing rather fast.
Yeah. Good. One more question I see here about LLM implementations done by large players for their clients. Large pieces of revenue will be going to these foundational models. True. Given the model learning capability and how they are evolving, isn't it a sign that the revenues will eventually shrink and a lot of market consolidation will happen, leading to fewer players? And that's a brilliant question. And I think, I mean, that's the knee-jerk reaction. But I think it's a very limited short-term effect because eventually, I mean, you need people to operate these LLMs. Anyway, I don't think ever it will be possible for them to run completely standalone. And I think it's just going to be, the technology will advance very fast. And in line with that, we will need humans to operate that technology. So not much afraid. I mean, and also my long-term view is that LLMs will be a commodity and eventually, I mean, will overcome all the supply chain issues. The only reason why LLMs are expensive is lack of energy and lack of chips. I mean, processing power. I think that that's not something that humanity cannot overcome. So eventually, I think it will be a utility like electricity today. We just take it for granted that in the developed world, we have water, electricity, heating, air conditioning, and intelligence on tap, essentially. And I think that will lay the groundwork for IT companies flourishing. That's my view. I mean, so far, obviously, there have been a lot of waves of technology and a lot of hopes. I mean, but eventually every technology ends as a toaster, no? We had this discussion in the software.
Yeah.
I mean, software is basically like toaster today, but I mean, someone has to operate it, no? So I'm not that concerned.
Yeah, the chart and the graphs and the deck will be sharing afterwards with all the participants. So that's going to be covered. There's an interesting question of the valuation of AI-enabled firms. How do you distinguish between firms that deserve the AI premium versus those that just ride in the narrative? I think everyone's riding the narrative a little bit those days.
Yeah.
So I'd say you need to have some substance, but you don't need to have a lot of it. You can be riding the narrative. We were looking before the webinar at the company that OpenAI acquired, and we thought, well, that looks like a regular IT services company that does some AI.
Not quite, actually, because
it's new. It started very recently.
It's new. Yeah. We've seen a pattern that they have shorter histories, and I think they were designed with AI in mind from the ground up. So, for instance, we spoke to one company that has AI the staffing for projects and time allocation. And I mean, there are a lot of these small details where AI can, I don't know, increase the margin by 1-2 percentage point, for instance. But these things compound, and we see that the cohort of companies founded in the last few years, they have different characteristics from the companies with 15, 20, 25 years of history. So it's you can fake it to some extent, but to me the DNA is different. The composition of the team is different. Much more AI engineers. The projects
But
are
the
different.
but the project they do, I wouldn't say it's rocket science, foundational
No,
models
not at all.
requires
No.
LM. This is quite regular stuff that I think OpenAI will be investing in, which is just rolling it out to everyone.
Yeah.
Making AI available, be it chatbot or some mini application or
Yeah.
something.
I mean, the biggest difference I've seen is just the will to do it. That people who have these companies that I would call AI native, they're passionate about AI. And they embrace it. I think it's like in the Western societies, 20 to 30% are optimistic about AI, and the rest of the society is negative. And I think just the founders of these AI native companies, they tend to belong to this optimistic group about AI. And the ones that don't adapt, they fall into the second category, that they see more harm than benefit, or they just don't want to change because they're happy with what with the status quo.
And that's why they're younger. Those companies are younger. They get a bunch of people together who believe in AI, and for someone who is 100,000 people across the globe, turn it around and kind of talk to everyone who maybe doesn't think it's gonna work, skeptical about this and that. Yeah, it's a great inspiration.
So, I mean, we've embraced AI totally, I'd say. And it's not rocket science, but it's just a shifted attitude that you have to learn to love AI, essentially. Yeah. So I don't see any further questions, or you do, Filip?
No, I think we can wrap up on that note.
Yeah. It's been fun. Thank you all for joining and asking these questions. We'll be sharing the webinar shortly. And stay tuned. More to come.
Thank you. Thanks.
Thank you. Bye-bye.
Bye-bye.